please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome. You're watching Business Lunch. I'm Nisha Podar and with me is Sonia Shenoy. Sonia, good afternoon. So markets did get a lift up today because of Rupee really opening slightly above the record levels that it had touched yesterday. But at the moment, Rupee has gone back to that 72.70 levels against the dollar, and therefore both Nifty as well as Sensex had also gone to the lowest point of the day, bounced back slightly. So it's a choppy day of trade in a very tight range. Both Sensex as well as Nifty have been trading today. The midcap index and that particular universe is really not helping the overall markets because that's in the red, about 0.5% or almost 1% down now. There's a sudden knock in the midcap index that we have seen. And take a look at Bank Nifty. That also is racing to the lowest point of the day, made a new low at this point, 0.3% down. So suddenly some weakness that is coming in the market, Sonia.
Absolutely. You know, Nisha, we missed you the last 2 days on Business Lunch. It was actually quite disappointing for the bulls. 2 days running, we saw pressure. And now, given today's fall, the Sensex is now down more than 800 points in 2.5 trading sessions. That's a lot, really, of selling pressure. And this afternoon, once again, the bears are using every opportunity to sort of slam the markets on the downside. We're seeing pressure pockets in the mid-cap space, more importantly. The Nifty Junior, you know, the ones that traders, that will tell you the sentiment of traders, that is under quite a bit of pressure. Look at the Nifty Junior now down to the lowest point of trade. But let's track Rupee and Crude because, as Nisha said, it is the most important internal to look at. The Rupee recovered from its record lows of 72.97 this morning and opened nearly 27 paise higher. Dealers say fresh selling of the US currency by exporters and banks, along with easing crude prices in the global market, has helped the domestic currency rebound. However, it's now come off its intraday high. It's still trading closer to that 72.70 $1 mark, so not looking that good.
Oh yes, Sonia. So while Rupee has really recovered from its record lows, it still has seen a little bit of choppiness in the trading day today. And Ray Faris of Credit Suisse believes that we could see some more pressure on the Rupee going ahead. But remember, government agencies have been singing a different tune, saying that Rupee weakness is a temporary phenomena.
I think markets are disappointed by the fact that the government suggested late last week that it might take specific policy action to stem pressure on the rupee. But then, as the weekend passed, we didn't really get anything that was particularly concrete. The RBI, I think, is likely to raise its policy rate again. Yes, inflation at the headline level has fallen, but core inflation, which has also come down, is still high, and I estimate it to be well above the RBI's target.
Okay, a lot of experts are expecting some radical measures from the government to stem the rupee fall, perhaps tapping into the NRI bonds or the FCNR as we call it. Also, maybe hike in import duties, etc. But let's see if those play out. For now, the rupee still continues to be closer to record lows. Oil prices, though, there's some relief there. Oil prices have slipped as US crude inventories rose by 1.2 million barrels. Reports suggest that Saudi Arabia is comfortable with prices above $80 per barrel. Another important indicator to watch out for is the ministers from OPEC nations and non-OPEC producers are set to meet on Sunday to discuss compliances with output policies. Also, US sanctions on Iran come into force on the 4th of November. But more important than NYMEX, really, we should track Brent because remember, Brent crude prices had gone all the way to $79 plus. At the moment, I think there is a bit of a cool-off that we're seeing there.
Yes, but Sonia, if we really look at the Indian equity markets and especially the frontline indices, what they have been doing all throughout for the last few days is mirroring the depreciation in rupee and the rise in the crude oil prices. And that's what is happening. In fact, the sudden drop in Nifty and Sensex has also come in as rupee has really weakened. And also remember that crude oil prices are not at very comfortable levels for us. So double whammy there as our import bill really inflates because of these two phenomena. On to the big voices. Let's get in some of them from the JP Morgan India Investor Summit, which is underway in New Delhi. Remember, Jahangir Aziz, the head of EM Economic Research at JP Morgan, says that there is no point in dealing the rate hike by the RBI?
There are much simpler solutions to these problems. There is much simpler explanation to where we are, why we are. But if we do not want to go with these simpler solutions and simpler explanations, instead we want to get tangled in the weeds with exports, imports, oil prices, we are going to come up with these kinds of very tangled solutions and tangled views. There is a very simple thing, and there is very little controversy about it. There are two reasons as to why the rupee is under pressure, like any other current account deficit. The current account deficit is rising, and global financial conditions have actually tightened through April till July. In August was very different. Then in August, emerging market risk was being reassessed. If you made up your mind, I don't know whether RBI has made up his mind or not, but suppose they have decided that they are going to hike in October 5th or 6th, whenever the policy date is, then it's much better to do that rate hike now, in fact last week, in fact the week before that, then delay it till October. The effectiveness of that rate hike goes away, diminishes the longer that is delayed. And I don't see these artificial things about policy review October 5th, therefore I can't hike before October. Those are just, artificial restrictions. So I'm not so much worried about how many rate hikes as I'm worried about how quickly the rate hikes come in. Because the more you delay it, the larger the rate hikes always end up being.
All right, entering into a higher rate hike scenario, that's what the world is expecting here in India as well. Now, we also spoke to Sunil Garg, the head of international equity research at JP Morgan, and he expects the earnings growth for India to be around 15%, and also adds that it is the Chinese markets which are really dragging the overall performance of the emerging markets.
We've lowered our estimates in terms of target price for MSCI Emerging Market Index and also some of the EPS numbers. But the fact remains that emerging markets are very cheap, and in fact they're trading at a much wider discount to historical averages, and that at least provides a value floor in emerging markets. So overall we are positive. I think the big driver here, it's going to be China, because China has been a massive underperformer. So it's not just some of the Latin American currencies that have been weak, but it's China's equity market that has been dragging down EM performance. We've had a very strong performance from here. I think in terms of where our Nifty targets are, it's probably a relatively modest upside at this point in time. If you look at some of the high frequency data points coming through, whether it's PMI, whether it's rainfall, whether it's the pressures from oil prices, I think these are going to be acting as headwinds, and we think the consensus earnings estimates are probably a bit too rich. They're about somewhere between 21 and 25% for either MSCI India or Nifty, and we think it's going to be closer to 15%.
Okay, so that's Sunil Garg of JP Morgan. They've cut their MSCI Emerging Market Index target. By the way, don't lose sight of the market. Now the cash market volumes have surged above 20,000 crores, and that's not a good sign when the market is falling. There's quite a bit of pressure. The market breadth is now worsened substantially, almost 1,300 stocks on the declining side. But across the globe, in retaliation to the US tariffs on Chinese goods, China has announced that it will impose retaliatory tariffs of up to 10% on $60 billion worth of US imports starting the 24th of September. These new levies will be imposed on around 5,000 American products. These include aircraft, soybean oil, smoked beef, coffee and flour. The move follows the imposition of a 10% US tariff on $200 billion worth of Chinese imports, remember. Incremental selling pressure on the market. Don't be fooled by the flat headline index. The market has actually lost a lot of ground in the last half an hour. And you can see it in names like Z Entertainment, down more than 3% right now. The Bajaj twins, Bajaj Finserv and Bajaj Finance are both down 2–2.5%. That generally tells you the mood of the market when a lot of these, wealth creators are actually giving up gains, which means that there is sort of people who are moving to cash now because of the kind of pressure that you're seeing. In fact,
Reliance Industries has moved to the low point of the day, and that is one of the big reasons for the sudden fall in the market as well. So keep an eye out on this. 1% drop in Reliance Industries has just become the biggest dragger, superseding HDFC Twins in really taking away the sheen of Nifty 50. So keep an eye out on that counter. Market has really entered into a slightly weakish sentiment at this point, Sonia.
Yes, it has. In fact, Titan is one of the top Nifty losers this afternoon after CLSA downgraded the stock to a sell and they've lowered their target price to 720. Sonal is here with more details. Also, you know, there is this fear of the rising import duty on gold that soured sentiment a bit. But Sonal, tell us more.
Yes, thanks a lot for that. And Titan is declining in trade today under some pressure, and that is because CLSA has downgraded the stock to a sell from an outperform. They've also cut the target price to 720 versus 1050 earlier, and this comes in after rupee depreciation and the government saying that there could be stricter policies for imports. Also, there are reports that are indicating that there could be a possibility of higher import duty on gold. So these are 2 points that is worrying the brokerage. Apart from that, they also think that there are concerns related to growth because Titan could not meet its Q1 FY19 guidance, and that is something they think will impact the FY19 growth as well. So overall, they are worried of the impact of a potential hawkish stance on gold regulations, and this is something they think will impact the premium valuations that Titan is enjoying. And this comes in after Credit Suisse had also cut the target price back on 12 September. They had cut the target price from 950 to 935. They also expected that Titan's growth will slow down further in near term. They expect a growth rate of around 16% in FY19. However, they've cut the EPS estimates by 2 to 3%. So that is something these two brokerages are saying, and this is after the management told us back in August that the jewelry segment growth that they had earlier guided by around 25% is under observation, and they will be able to do around 20% growth, and that's why Titan is in focus. Back to you.
All right. Thanks, Sonal, for getting us all those details. Now, the entire AMC pack is in focus today and reeling under pressure. SEBI has batted another one in favor of the investors, ordering the mutual fund houses to cap their scheme expenses and provide the benefit of economies of scale to the investors. And Rima tells us more about this. Rima, how is it going to impact the AMC companies in terms of their profitability?
Yes, the news is that SEBI has cut the total expense ratio or TER for mutual funds, and this expense ratio cut progressively increases for larger schemes as well as for those with a higher equity share in their AUM. So therefore, the impact is most on HDFC AMC as well as Reliance Nippon AMC. Now, just to give a breakup, so the impact on AMCs with an AUM of less than 2,000 crore rupees is negligible. For AMCs with an AUM between 2,000 to 5,000 crore rupees is roughly about 10 basis points, and for AMCs with an AUM in excess of 5,000 crore rupees, the impact is anywhere between 20 to 30 basis points. Now, yesterday's cut in the total expense ratio comes over and above the 15 basis points cut in the expense ratio which had come through in June, and at that time CLSA tells us that the mutual funds had passed on about 70 to 100% of the impact to the distributors. So now the question arises is that will the AMCs be able to pass on the negative impact of this by lowering the distribution commission to the distributors? CLSA says that if the mutual funds manage to pass on about 50 to 70% of the TER cut, then the impact on the earnings will moderate to about 10%. But the other question arises is for the larger schemes, will they lose market share? Because now distributors could migrate to smaller AMCs due to better commissions, because the smaller AMCs are not impacted that much by the TER cut. So therefore, they may not cut back on their commission. A few brokerages, Nomura has downgraded a Reliance Nippon AMC to a neutral. They've cut the target price to 210. JM Financial too has cut the target price on Reliance Nippon. They've lowered the target price to 275. Morgan Stanley has written on HDFC AMC, where the target price is lowered from more than 2,000 rupees to 1,765. Though they continue to maintain an overweight rating, while CLSA on ICICI Securities says that the mutual fund distribution fees form about 15% of their revenues, and a 10 basis points cut in their fee could impact their FY19 PBT by roughly 4%. Back to you.
All right. Well, thanks a lot, Rima, for that. But let's do one thing. Let's speak about another issue. The SEBI will open the commodities derivatives market to foreign investors. And to discuss the impact of that, we have Mrugang Paranjpe, the MD and CEO of MCX. We also have our commodities editor, Manisha Gupta, with us. Manisha, over to you.
Thank you so much for that, Sonia. Well, Mrugang, thank you so much for joining us. First of all, it really is something to cheer about because the markets have been waiting for more participation than just the retail that we see on the Indian commodity exchanges right now. With the advent now, with the framework ready for the foreign participation, what is your sense on how much will that really open the market?
So, Manisha, I think in line with the developments that we've seen over the last couple of years, this is one more step in that right direction of one, expanding the Indian commodity derivatives market and deepening it with broader participation. We saw that with SEBI allowing AIFs last year, and we're seeing this as the next step. We are also seeing steps in terms of more products coming in. So to me, this is one of those many things that we all wanted to do together to make this a very large market, and that's why it's a great step, a big step in the right direction. In terms of an immediate assessment of impact, I think, again, we've maintained this when we introduced derivatives in terms of options, when we introduced them about a year back. We said this when the first institutional participants came in, is that each is a small step. I think in the long run, we believe the Indian markets have a huge potential. We don't give specific numbers or guidance in terms of any quarter or anything, but we've always maintained that since the last year and this year that we see over this 3 to 4 year horizon the overall volumes and revenues for the exchange doubling in terms of the size, and this will be one big contributor to that increase.
One word on the farm derivative turnover fee as well, and it would be a nominal 1 lakh rupees that the exchanges will have to pay to the regulator now. How much is the savings? The SEBI also talks about creating a different fund to ensure that there is farm and FPO participation. What is the work being done in that direction now?
So I think, Manisha, this is a conscious effort being done by all the exchanges and by us as well to make sure that our engagement with the farmers gets deepened, but also because in a larger context to make sure that the relevance of this activity to the society in general becomes much more apparent. In that sense, last month with the guidance of SEBI, we made one big change in the mark-to-market that members have to pay, where we have already exempted FPOs from paying mark-to-market from the day they make deposits into the exchange. This is the next steps. You will see more of this as an exchange. We are working with our WSPs to expand. So, for example, we signed a cotton mission agreement with the government of Maharashtra. We are now going to expand under that with 3 more warehouses in the Vidarbha region. We are working aggressively to get FPOs enrolled. We will also work to see how we can cut the costs on the warehousing as well as assaying, specifically for FPOs. And in a lot of this, it will just be the exchange defraying those costs, not really cutting those costs in general. But you should see a slew of steps because I think it's very important to get the FPOs and the direct farmer engaged with the commodity derivative segment.
And markets in the red right now, so there is weakness, and Reliance Industries continues to be at the low point of the day, close to 1% down. Hindalco has lost quite a bit of ground in the last few minutes of trade as well. So keep an eye out on the markets. But one important development today that we are watching out for, in fact, sources tell CNBC TV18 that KM Birla's retail company, Aditya Birla Retail, is likely to announce a deal with Amazon-backed Samara Capital soon today. So what we do gather is that it's going to be a large transaction worth about 4,200 odd crore rupees. Remember, more stores, that is the retail brand of supermarkets as well as hypermarkets under Aditya Birla Retail, and that has about 600 stores across India, and that being priced at 4,200 odd crore rupees, where Samara could be buying a majority stake and Amazon will also be putting in money, probably at 49% stake. Pranab Barua, who heads more, could also really cross over to the new buyers. So that's a large announcement in line with Amazon's omni-channel approach here in India, Sonia.
Okay, well, that's interesting there. We'll get to know more about more later in the day, perhaps. But for now, moving on, Northern Arc Capital, formerly called the IFMR Capital, which provides access to debt for underbanked businesses, is looking to raise about 600 crore rupees in a pre-IPO round. Bids for this are likely to be open today, we understand. CNBC TV18's Priya Sheth has this exclusive. Priya, what will the funds be used for, and when is the IPO planned exactly?
Well, lots of IPOs coming in the market, but of course, as far as Northern Arc Capital is concerned, it's looking to raise about 600 crore rupees via the private equity route. This is, of course, a pre-IPO round that we do understand. Now, about 8 to 10 private equity players have expressed interest as far as the whole bidding process is concerned, and the bids are likely to be opened today, is what we understand. Of course, existing investors include Standard Chartered Private Equity, Leapfrog, as well as Fidelity International, who together own about 55% in the company. So they may look at diluting some of their stake. Some funds may also be used by the company to support their existing business as well as strengthen the business ahead of the IPO. Now, the IPO, we do understand, is being planned for FY20. So anywhere between May and June 2019 is when the company will perhaps go ahead for an IPO. Valuation as well as stake dilution will be decided post this funding round. In fact, we did reach out to Northern Arc Capital, and the company is yet to respond to our query.
All right. Thanks so much, Priya, for getting us that exclusive bit of information. Company getting IPO ready, but the market choppiness is not much of an inspiration right now. With that, it's a wrap on Business Lunch.